How to stick to an investment plan during volatility. Imagine watching your investment portfolio fluctuate wildly and feeling your heart race. It's a common scene during market ups and downs, but sticking to your plan is key. So how do you stay committed when markets get bumpy? Let's explore some proven ways grounded in facts and real strategies. First, remember that markets go through cycles. Short-term drops are normal and expected. If you focus only on today's prices, you might panic and sell at a loss. Instead, keep your eyes on your long-term goals. Historical data shows that staying invested through downturns often leads to better results over many years. Trying to time the market by selling during dips and buying during peaks usually results in missed gains. Accept that market ups and downs are part of investing and stay the course. Next, make sure your investments match your comfort level with risk. If market swings cause you stress, consider shifting to more conservative assets like bonds or cash equivalents. This helps you avoid impulsive decisions driven by fear or greed. Your risk tolerance should align with your investment horizon. If you plan to retire in 20 years, you can usually handle more volatility than if you need money in the next few months. Diversification is another powerful tool. Spread your investments across different asset classes like stocks, bonds, and short-term instruments. Within each class, choose a variety of sectors and regions. This way, if one investment performs poorly, others might do better, balancing your overall portfolio. Diversification doesn't prevent losses but helps reduce the impact of any single poor performer. Use consistent investment strategies such as dollar-cost averaging. This means investing a fixed amount regularly, regardless of market conditions. Over time, this approach can lower your average purchase price and reduce the risk of buying at a high point. It also removes the guesswork of trying to predict market movements, which is often unreliable. Sometimes, small tactical adjustments can help. For example, rebalancing your portfolio periodically to maintain your target asset allocation keeps your risk level steady. If you expect a prolonged downturn, you might temporarily increase cash holdings to avoid selling investments at a loss. But avoid making large, frequent trades based on short-term predictions, as this can increase costs and risks. Liquid alternative investments are another option for diversification. These are strategies that mimic hedge fund approaches but are more accessible and easier to sell. They can provide additional risk management and potential gains during volatile times, giving you more flexibility to adjust your risk exposure. Emotional reactions are a common challenge. Fear can lead to panic selling, while greed might cause you to buy high. Recognize these feelings and remind yourself of your plan's rationale. Staying disciplined helps you avoid costly mistakes that can set back your progress. Tax strategies can also help during downturns. For example, harvesting tax losses involves selling investments at a loss to offset gains, reducing your tax bill. Roth IRA conversions when your account values are lower can also lower future taxes. These tactics can improve your overall investment efficiency. Finally, keep some cash reserves ready. Having money set aside in low-risk accounts like money market funds allows you to buy opportunities during market dips without needing to sell investments at a loss. This flexibility can be a real advantage when markets are unpredictable. By sticking to your long-term goals, aligning your risk tolerance, diversifying wisely, and maintaining emotional control, you can stay committed during volatile times. These steps help you avoid reactive decisions and position yourself for the market's eventual recovery.